My name is Zachary, and in this video, we're going to be focusing on three main things. First and foremost, we're going to be talking about what slippage is. Secondly, we're going to be exploring a little bit more and talking about what gaps are, as well as imbalances. And last, we're going to be discussing what causes these things to happen, and also taking a better look at how they actually affect the market and the psychology of the masses. So let's go ahead and get started first with slippage. We've got gold up in front of us right now on a 1-minute chart. Very small time frame. And what we're going to do is we're going to walk through what a support and resistance trader may experience if they fall victim to slippage. Based off of what you've learned already, should be pretty easy to identify that this so-called support level that so many people around the world would be able to see is also liquidity. We're going to have lots of money sitting below this area. If our support trader sees the market coming down and into this area, they decide to buy. And perhaps this is what their trade looked like. They decided to purchase a position on this candle. Once the spread was factored in, they got their fill near 1797.5. They're risking about 12 pips, and they were targeting about 85 pips to the upside, bringing their reward to risk to a 7 to 1. On paper, this looks like a great potential trade for our support trader. Now, once they get in, the market decides to just kind of chill around for a little bit. We do understand that on a minute chart, each and every single minute that passes is going to give us a new candlestick. So not much time has passed between when our trader entered the position and when our trader in this example that we're talking about was reflecting on what might they want to do now that they're at break even. They decided to check the news. And they noticed that on this day, July 14th, there was no news between the hours of 6 and 7 a.m. That was when they were trading. And so there really wasn't anything fundamental on the table that could affect this trade. Suddenly, this happens. And we get that liquidity capture within a single minute. The market drops 70 pips to the downside, and our trader has been stopped out of the position. Now, even though we're talking about a hypothetical example, you're probably thinking, well, it's not the worst thing in the world. They only had a 12 pip stop loss. They would have been protected and taken out of the market. What I'm here to show you today is that slippage does not guarantee that you will actually get out wherever it is that you're setting your stop loss or your take profit. This is an example of an actual trade. And as we can see, the day, 0714, the time lines up with this position. And we can see that even though the original stop loss was 1796.30, right where I have this red line at the end of this box that we are using for our hypothetical reward to risk plan, we can see that the price that the trade was exited was at 1790.52. So right down here near this purple line. If we were to measure the difference between the planned stop loss and where the trade was actually exited, that was 57 additional pips to the downside. Stuff like this can happen whether there is news or not. Imagine for a moment that this was you that was taking this position. You had originally planned for a 1% risk, only to experience slippage in a move like this, and suddenly, rather than risking only 1%, you suffered a 10% loss or more. I want you to realize that when you are participating in the markets with real money, you are going to be up against stuff like slippage. Not only can you lose the money that is in your account balance, you can actually go negative. And if you experience a negative account balance, your platform would look something like this, and you will actually owe your broker money before you can resume trading in the markets. Slippage is something to be aware of, but it is not something to be scared of. With proper risk planning and awareness, you can take the steps that you need to in order to minimize the possibility of experiencing these types of losses. Now, it's definitely not guaranteed that in your entire experience being a market participant that you'll never run into some sort of slippage or market gapping. This type of move, even though it slipped, it created an imbalance in the markets. Slippage generally happens because there is either a large amount of volume entering the market all at the same time, or there is very thin levels of liquidity. And we can see by going and taking a look at something like GBP AUD that manipulated moves like this, if you take a look at what I've circled here in the wick, we can measure from the open of that candlestick to the high on the wick. That is about a 2200 pip movement. When we go and we look at a different chart, like the FXCM, that wick does not exist. Now, these imbalances in the markets, they can happen while the price is moving, while the market is physically giving us updates second by second. But what happens when the market is closed? What happens when over the weekend we get something like this? And you see the market close at one price and gap higher or gap lower than where that week came to an end. What I want you to understand is that even though the markets seem to have specific hours that they move, in Forex, that's from 5 p.m. Eastern on Sunday to 5 p.m. Eastern on Friday. For that duration of time, we can see updates in real time about what is happening with the price. However, over the weekend, even though the market seems like there's nothing going on, money is still moving, and that is one of the main causes of these gaps that occur over the weekend. Now, the gaps can be a lot easier to see when they're nice and big like this. The imbalances that exist within the actual candlesticks for instance. Instead, may look more like this, where you have the market moving very quickly in a single direction without slow and steady price action. Either way, just like we were talking about with slippage, gaps work in pretty much the same way. Gaps are caused by large amounts of money flooding into the market all at once. Gaps can also be caused by low levels of liquidity and thin order books that do not give people the ability to get their entire position filled at one price. In another video, I showed you a clip of what happens when there is a large market imbalance and lots of money enters the market all at the same moment. In case you haven't seen it, I'm going to take the opportunity now to show it to you once again. Now, it's not every day that we see movements such as what we just saw in that clip, or even if we were to look at another chart, such as the XBT CAD, where we see the price go from 11,898 down to 101 with 20 cents in a matter of minutes. However, when these large gaps and imbalances exist in the markets, especially if they're visible, such as ones like we were looking at on the euro the other minute, whether it's this one, whether it's that one, whether it's the one we were looking at on the weekly chart, these areas are magnetic. And we can see exactly what type of reactions we get when the market trades to and eventually away from these areas. They are highly sensitive. So anytime that you see a gap, whether the imbalance has been traded to or traded through, remember this. If in the past a specific price level or region was able to generate enough market participation to move with such force that it caused a physical gap that is very, very easy to see with your eyes, you need to expect that in the future, that is going to be a magnetic and highly sensitive area for price. If the imbalance is a little bit more difficult to see with your two eyes, realize that within the candlesticks, where you can visibly see fast movements with mostly body and very little wick, you can still identify those imbalances with the expectation that eventually they're going to be filled in. The last idea that I'm going to leave you with in this particular training is this. If it's fast, it won't last. If it's slow, it will grow. Knowing what you now know, and understanding that there are conflicts of interest that exist within the realm of the markets, we're going to end this video with a clip that shows you how sometimes what you believe is an imbalance will be demonstrated by your broker in the form of a candlestick. But that candlestick may not actually be there to begin with. We were looking at 10,625 and why we were targeting that imbalance. And I don't know if it's just me, if my eyes are playing tricks on me or what, but a minute ago when we were looking at this exact same chart, there was not a candlestick there. There was a gap there, and now there's a candle. So did you see that as well, Jordan, or is it just me? Candlestick magically appeared.
I'm wondering. I mean, I've seen it do it multiple times. It's like they just like fill it in, just make up some magical candle.
I don't know what just happened. Like literally 30 seconds ago, there was a gap, and now there's a candle. It was the same target either way. You know, we're looking at the same price point, but there it is. There we go. The candle disappeared again. You can see these imbalances with your eyes as you put in the time to train them. You know, just because there was a gap here that we could see, that is apparently switching back and forth between being a candle. Maybe it doesn't want to be a candle today. Maybe it'll want to be a candle tomorrow. As you could see, we were able to identify that imbalance when there was a candle there, and now the candle is gone again.